Connor, good morning. Okay. Guys, good morning.
With me, or just without me. Let's do a quick.
We're getting near the end. Hello? It's neither morning nor afternoon, so I will say good noon. How's everybody doing today? No response. I've got to learn how to do that. Reactions. Okay. Didn't take long to find. Before we get started, I sent you a 4-page memory aid typed, right? Okay. You may write anything else on it you wish. So I guess what would have been your own personal memory aid, you can write up in the margins of those 4 pages I sent you. Unless someone objects. The student in my 10 o'clock class was very persuasive. She made me feel guilty if I didn't permit that. But she did it in a very subtle, very professional manner. It was really good. All right. What I plan to do today, and this will finish off chapter 12. I want to work, well, really the one remaining problem we haven't worked, the Lose Corporation. It was originally slide 24 in your slides. And then I want to go through the weaknesses, the limitations of, or guidelines of the whole approach in this chapter. First, let's see if my PowerPoint will behave. All right. All right. This is the problem. It's on 2 slides that I want to work with you. Loose corporations considering a new project. The equipment will cost $2 million. It will be depreciated as MACRS 3-year property. Loose forecasts annual sales of $3 million, annual cash operating costs of $1 million. They'll terminate the project after 2 years, sell the equipment for what they think will be $500,000. Initial working capital of $50,000 for the purchase of spare parts inventories will be made, but we expect to recover that at cost at the end of the project. The tax rate is 40%. What are the project's cash flows? So to recap some of that, the equipment has a cost of $2 million. And this is a 2-year project. Now, the depreciation schedule, MACRS, has depreciation in year 1 shown to be 33.33% of the cost. In year 2, 44.45%. And something I didn't give you in the slides, but you will have on the test, would be depreciation in year 3. Were the project to last that long, 14.81%. And finally, depreciation in year 4 would have been 7.41%. Well, let's get all this stuff down. The working capital investment. It's $50,000. The salvage value of the equipment in year 2, $500,000. Tax rate's 40%. Additional sales for years 1 and 2, $3 million per year. And cash operating costs for years 1 and 2, $1 million per year. And what else? All right. So we tackled the problem like we have been in the chapter. First, we look at the initial cash outlay. That is, if we invest, what will be our cash flow at time 0? Well, one thing we'll clearly have to pay for is the cost of the equipment. Which would be a $2 million outlay. And we'll also have a working capital investment in spare parts inventories of $50,000, and that's the only working capital item. Since working capital would go up, that would be a cash outflow. Or another way to think of it, if we buy more inventory, spare parts, that would be a cash outflow. Excuse me, sorry. So our cash flow at time 0, a negative $2,050,000. We're 1/3 done. Another segment of cash flows would be our annual operating cash flow, or you can think of this as annual cash profit. And we'd have this for 2 years. We've got a, here we look at everything that lands on the income statement, but we put it in after-tax form. So one of the things we'd have in both years would be sales. Now sales would be $3 million higher each year, but it's taxable. So if we knock out taxes, that means our after-tax benefit from sales would be, what is that, 1,800,000. And this would be true for both years. We would also have a difference in cash operating costs. What was it, 1 million? But because the operating costs, things like the cost of labor and materials, are tax deductible, we do get a tax savings out of this. So after taxes, this would really cost us $600,000 each year. And the one last item that lands on the income statement, it's not a cash cost, but it's deductible. So it lowers our taxable income and saves taxes. It's the depreciation. Depreciation tax savings. So we get to take the cost of the machine and our depreciation allowance for year one is 33.33%. This gives us the depreciation expense. To see what we save in taxes, we multiply it by our tax rate. Whatever our depreciation expense is, we get to deduct it, we get to lower our taxable income by that much. So after taxes, that would be, let's see, there'd be a tax savings of $266,640 in year one, and it would be an inflow because it's a tax savings. And in year two, what changes is our depreciation allowance. In year one, it's 33.33%. In year two, it's 44.45%, according to our table. And that would be depreciation tax savings of 355.6. And these are the only items in the information given that lands on the income statement. So our difference in operating cash flow, that is cash profit for year one, right, $1,466,640. And then year two, a little bit bigger figure. And we're 2/3 done. The third segment of cash, is there a question? I need to pause and ask for questions. Anybody? Okay. Wait, I won't stay right where I am. Go here. The final segment of cash flows for the project is the terminal cash flow. Since this is a 2-year project, that is, we'll shut it down after 2 years, think of this as an extra cash flow in year two. Now, one of the things we have to contend with, and that was the piece of information I didn't put on earlier on my slide. Sorry, guys, I'm fishing for it. There we go. The one thing I forgot to put on is we have an estimated salvage value in year two, 500,000. Now back to what we were doing. Okay. The terminal cash flow. One of the things that we have to contend with when we sell a depreciable piece of equipment, our government will compare what we sell it for, that is its salvage value, to its book value. If we sell it at book value, the government says fine, no tax effect. If we sell it at above book value, we have to pay taxes on the gain above book value. So to start this, we need to look at the book value after 2 years. Now, you can calculate book value like you did back in accounting. You can take original cost minus depreciation taken. But something else you can do that's sometimes shorter is you can calculate untaken depreciation. After 2 years of depreciation, we'll have not taken the year 3 depreciation or the year 4 depreciation. So that's another way to arrive at book value. I'm getting a book value of $444,400. yet we think we can sell this for $500,000. So that would produce a taxable gain in year 2. We think we can sell it for $500,000 when it will be carried on the books at a little less. So we'd have to pay taxes on the gain. A gain of 55.6. The actual taxes we pay on that gain, since we're in a 40% tax bracket, and we've got that taxable gain of 55.6, that produced taxes of 22,240. So our salvage value after we take the tax into account would be the $500,000 we sell the thing for. Plus how much of it we have to give up to the government in taxes. And that would leave us with an after-tax salvage value of, I'm getting $477,760. So our terminal cash flow would consist of the salvage value after tax, and that'd be an inflow. And we would also expect to recover our initial working capital inventory. I think that was going to be spare parts inventories. Now we'd sell them all. And we're assuming we're recovering that at cost. So our terminal cash flow would be 527,760, I think. Yep. And that's all 3 parts. If we put them down together, it's actually a pretty good looking project. We have a cash outflow of $2,050,000. But then we have cash inflows of 1,466,640 cash flow from operations in year 1, then another 155.56 in year 2. But also in year 2, we have that terminal cash flow. So since they occur at the same time, we can just add them. And that works out to, I'm so bad at math. I'm getting 2,000,000 23,360. Are any of you getting these same figures? Has anybody been cranking this along with me to see if I make a math mistake? Well, anyway, assuming cut has not made one of the typical math mistakes, that's our project. Now, I didn't give this to you, but if you wanted to evaluate the project, let's say this is a really risky project. The cost of capital is 20%. What would the NPV tell us to do? What would the IRR tell us to do? If you were to solve for these using your calculator, let's say, I think more of you have the BA2 plus than anything else. You'd clear out all the old values. It would prompt you for the cash flow at time zero, which would be $2,050,000. You'd make it negative. Then it would prompt you for the cash flow at time one, or the next cash flow that would meet 1,466,640. And after the year zero cash flow, when you give it the other future cash flows, it also asks you for the frequency. By default, we take the default frequency of 1, meaning it occurs one time. Then 2,083,360. Check something very quickly here. Yep. Then to calculate NPV, you could hit NPV. It would prompt you for the discount rate, which is 20%. And if I did this, I get an NPV of a positive, well, a big number. Based on that NPV, we would accept, since the NPV is greater than 0. If I also, while I've got all those cash flows in there, wanted to calculate IRR, I could simply hit IRR, compute. And it would give us the IRR, which is also a very impressive number. And based on the IRR, we would accept, since the IRR is greater than WACC. We've got an IRR of 42.7% and a required return of 20, so we would accept. Any questions on this problem? Well, let me throw something else in. If I can find it. How about that? I got lucky. Okay. See those depreciation percentages? Those are the ones I've been using all semester. In the prior edition of this book, they were actually simpler. Year one depreciation was simply 33%. Year two was 45. Year three was 15. Year four was 7. Your depreciation percentages for you to use in each problem will be given in the problem. Simply use the depreciation percentages that are given. If they give you these 4-digit percentages, use those. If they give you the short percentages, use those. Any questions on that? Some of the problems in my test bank I created after this current edition of the book came out. Some I created from the older edition. The older edition had these 2-digit percentages. If you draw a problem with those, say, yay, it's simpler, not as messy. The one other thing I wanted to do today was to cover the weaknesses or guidelines, I call them weaknesses, for our cash flow estimation. In fact, let me do this. This will be easier. Okay, new share. What I'm going to do is a little bit wonky, but it works. Can you see that? Cool. All right. The first of these guidelines points out something that's pretty important. You know, we're given forecasted sales, forecasted cash operating costs, and so on. And from that, we develop the project's cash flows. And from that, we calculate things like NPV, IRR. But these forecasted sales and cash operating costs are from looking into the future. They're only estimates. They're only estimates of what we think those figures will be. If our forecasted sales are way off, then our NPVs and IRRs will be way off. The value of the project NPV and IRR and MIRR and payback, the value of those measures is only as good as the accuracy of our forecasts that came up with the cash flows that those NPVs and IRRs were based on. I'm sure you guys have heard of the phrase GAGO, garbage in, garbage out. If our sales and cost estimates are way off, that means these capital budgeting measures like NPV are way off. Here's another one for you. You know, capital budgeting projects are ideas that the company came up with. Often, one person will spearhead the idea. Nissan had somebody that was the primary force. Sorry, 1 second. Okay. I'm sorry. My wife was clanking dishes in the kitchen. I don't know if you heard them or not. Somebody comes up with the idea. Somebody in Nissan said, hey, let's build a factory up there in Mississippi. Should the person who came up with the idea for the project be in charge of its analysis? Yes or no? I think I'll wait you out till somebody responds.
No.
Why not? I agree with you, Jason. Why not?
They could show bias in trying
They're
to
gonna
promote
be
the project that they wanted.
The project's gonna be their little baby. For all we know, they may even have a special bonus tied to the project if it's accepted. So the answer to this question, should they be put in charge of the analysis? No. They may be biased. When we forecasted project cash flows, well, for that matter, these annual operating cash items, were they based on book profit or cash profit? For this, think about the annual operating cash flows. Let me take you on a trip down memory lane. This is why I chose this method instead of the PowerPoint show. Earlier, we used the short method of expressing each item on an after-tax basis. The sales after tax, cash operating costs, and depreciation tax savings to come up with our operating cash flow. But I showed you another way where you could build an income statement and run it. Well, a normal income statement would run from sales down to net income, but net income is a measure of book profit. To arrive at it, we deducted an item up here that was really not a cash expense. So to adjust the final operating cash flow figure, we added back in depreciation, which means the operating cash flow is actually a measure of cash profit rather than book profit. Why did we do that? You can't reinvest book profit. You can only reinvest cash profit. You do the same thing. When you're thinking about a job and your salary, what you focus on is what you get to take home, your actual cash profit. For the Zappo project cash flows on a before tax or after tax basis. Or let me phrase that differently. Before tax would mean we ignore taxes. After tax means we consider taxes. Which did we do? Did we consider taxes anywhere in our analysis? Yeah, everywhere. Again, let me back up. Back when we were looking at sales, we looked at it on an after-tax basis. Same with operating cash flows. We considered taxes. Even in the terminal cash flow, we considered taxes. We considered it everywhere. So, were the cash flows on a before-tax basis or an after-tax basis? Or said differently, did we consider taxes or ignore them? We definitely considered taxes. So our analysis was based on cash flows after taxes. In the project analysis, in all your problems, the only non-cash expense that we looked at was depreciation. Actually, companies can have 3 different kinds of non-cash expense. Of course, the big one is depreciation. But another type of non-cash expense is amortization. And virtually every company has both. What's amortization? If a company sells bonds, for example, and after flotation costs, they net less than face value, they're able to take that amount less than, let's say they sell the bonds to the public for $1,000, but they only net $950. That other $50, they're allowed to amortize over the life of the bond. That's really like depreciating it. It's a non-cash expense like depreciation, but the benefit is it lowers taxable income. Just like depreciation expense lowers taxable income and saves taxes, amortization expense lowers taxable income and saves taxes. And actually, this is a third kind for companies that deal with minerals, natural resources. It's called depletion allowance or depletion expense. Let's say you've got a coal mining company. They own land. They're extracting coal from the ground. After they've taken some coal out of the ground, there's less coal left. So the ground is worthless. In a sense, they're allowed to depreciate the ground. That's what depletion expense is. Coal mining companies, any company that mines or drills for natural resources. Okay. Should financing costs like interest expense, dividend payments, should we have deducted those to arrive at our operating cash flows? For example, if we go back to that example I showed you earlier, where we're looking at an income statement. Let me get rid of what I put there. Now notice this was one way to get to operating cash flow. Did we deduct interest expense? Normally it would have gone right in there, right? After we've deducted everything but taxes, we deduct interest expense, but we didn't. Nor did we deduct dividends. Did we make a mistake? No. So where do we take financing costs into account? Things like interest expense and dividend payments, they are reflected, captured, ever how you want to look at it, in the weighted average cost of capital. Remember, the weighted average cost of capital is the after-tax interest rate on debt times the weight for debt plus the stockholder return times the weight for equity. Interest expense is reflected in this interest rate. Dividend payments, if we use the dividend model, if you recall, our SABES was the dividend in the coming year. We take into account dividend payments in our cost of equity. We take into account interest expense in our cost of debt. The short answer is this: we don't account for financing costs in our cash flows. Instead, we account for them in our discount rate we apply to the cash flows. Remember, after we got a project's cash flows, we calculated what? NPV. But what was our discount rate for NPV? The WACC. That's how we accounted for financing costs. It's in the discount rate, the WACC, not the project cash flows. I keep going down memory lane. Back when I gave you this information on this first project, I mentioned that a marketing survey costing $10,000 was conducted to come up with a sales and cost forecast, sales forecast primarily. It's been paid, it's been expensed for tax purposes. Did we take that into account anywhere in our analysis? No. Should we have? No. It's money that's been spent. The tax effect has already been captured. And we've spent the money, whether we accept the project or not. I don't know if you remember this, but the definition of an incremental cash flow is the cash flow for the whole company if they accept the project minus what the cash flow for the whole company would be if they reject the project. So, how much have we spent on that marketing survey if we accept the project? 10,000. How much have we spent if we reject the project? 10,000. That all nets out to zero. What's another name for money that's been spent, whether you accept a project or reject it? You ever heard of the phrase sunk cost? Or if you talk to your grandparents, they probably talk about spilt milk. Don't cry over spilt milk. A sunk cost is not an incremental cash flow. It's not affected by whether we accept the project or turn it down. So what should we do with sunk costs? They should be omitted from our analysis. You get offers from two companies. Both companies give you a free membership to Gold's Gym. I have no idea what that costs. Let's say $500 a year. Both companies offer you that Gold's Gym membership. Is it a factor in deciding which company you're going to work for? No. It is a sunk cost. So you omit it from your analysis. Just as we omitted the cost of the marketing survey. Why? Because it was spent, whether we accept the project or turn it down, so it's not a factor. You omit sunk costs from your project cash flows. Makes a great test question. Should opportunity costs, such as forgoing the chance to sell land for the project site, be included in the analysis? Look, what if we've got a company and it's looking at a project and the land that it would put the project on could be sold today for $50,000 after all tax consideration. Let's say it's this loose company. I'm now giving you more information. If they accept the project, they're going to put it on land that they could sell for $50,000 today. If they don't accept the project, if they accept the project, they're going to use land that otherwise could be sold for $50,000 a day. If they accept the project, they expect to sell the land for, I don't know, $55,000 2 years from now. Should that be added to our analysis? Yeah. Remember the definition of an incremental cash flow. It's the cash flow for the company if they accept the project. Now I'm going to go vertical on you. Minus the cash flow for the company without the project. And that's our definition of an incremental cash flow. This is today, this is 2 years from now. If they accept the project, will they sell the land today? Well, no, they need it for the project. When would they sell it if we accept the project? 2 years from now. If we reject the project, when would we sell the land? Today. And of course, you can't sell it twice. Well, by definition, our incremental cash flows are the cash flows with the project minus the cash flows without the project. So 0 minus 50 would be a negative 50,000. If we go ahead with the project, we give up the opportunity to sell the land now. And then, of course, 2 years later, we'd get that 55,000. What do you call a cash flow that you forego if you accept a project like this 50,000? That's called an opportunity cost. Should we take opportunity costs into account in our project cash flows? Yes. We omit sunk costs, but we include opportunity costs. If you own a truck and you're thinking about starting a small business, and with the business, you'll use the truck for deliveries, and otherwise you'd sell the truck today for $5,000. You should show a $5,000 outflow today as an opportunity cost. $5,000 you forego today if you accept the project. Should externalities, such as the new project cannibalizing the sales of other products, should that be considered? If Apple comes out with a new iPhone today, and they forecast the future sales of that new iPhone, what should they take into account? I'll wait you out till somebody makes a guess. Oh, I won't. Okay, I'm impatient. If they're coming out with a new iPhone and they forecast the sales of the new iPhone, they need to take into account how many of those people that are buying their new iPhone would have bought one of their existing iPhones. Or a classic example of this is Ford. This was before your time, but a few years ago, they came out with a huge passenger vehicle called the Excursion. And in forecasting the sales of the excursion, they should have considered how many of those sales would be customers that would have bought their other large passenger vehicles like the Navigator or the Expedition. I don't know if they did or not, but I do know one thing. They didn't keep the excursion for very long, so who knows? Now, not all externalities are negative. For instance, you could have a chain of stores that sells sporting goods, you know, baseball bats, gloves, basketballs, tennis rackets. And they might add a line of sporting clothing, tennis shoes, gym shorts, yada, yada. It's possible that by adding the clothing line, their equipment sales might also go up. People that stroll in to buy some of the clothing might decide to buy a tennis racket and vice versa. In fact, that's kind of the heart of Walmart, isn't it? They hope when you come in to buy a carton of milk, you'll walk out with a sofa or something. So should externalities, whether they be negative, like cannibalizing the sales of other products, or positive, should they be considered? Yes. Should management options be considered in the analysis? A very common management option is something called abandonment. You have a 5-year project. You should look not only at running it for the full 5 years, but you should look at the possibility of either shutting it down or selling it after maybe 3 years. A lot of young entrepreneurs start businesses hoping it will attract the attention of large companies that buy them out. If you've ever seen Shark Tank, that's an awful lot of what Shark Tank's about. But that possibility, if there's some way you can estimate it, it should be considered. And finally, should our project cash flows be expressed on a real basis, which means we ignore inflation, or should they be based on a nominal basis, which means we consider inflation? Okay, another trip down memory lane. Here. Here. Earlier with the very first problem we worked, we forecasted sales to be the same dollar figure. Whoops, it's something brighter. The same dollar figure year after year. Does that look like we took inflation into account? If we had assumed there would be some inflation, then each succeeding sales figure ought to be bigger than the last. In other words, if we're selling our products at 20 bucks each in year one, we might have assumed that we could sell them for a higher price in year two, in which case we might have had a higher figure for sales for year two, and yet a higher figure for year three. And for that matter, did it look like in our cash operating costs, the cost of labor, the cost of materials, did it look like we took inflation into account? Was the same dollar figure each year? No. We would have expected the cost of labor and materials to maybe go up each year. Now, did we make a mistake? Yes. Why didn't I include inflation in the example? It would have made it so much more messy. It would have obscured the primary points I was trying to get across to you. But we really should take inflation into account, which means our cash flows should not be based on real figures. They should be based on nominal figures. In other words, when we're coming up with our dollar sales for the next year, we ought to use the actual price we think the items will sell at. That is, include inflation. Project cash flows should include inflation. Now, what I'm about to say next won't sink in, but just in case. You know, we're going to discount them using the WACC, which, again, is the weighted average cost of debt and equity. Here's my point. When lenders quote an interest rate, built into that interest rate is an inflation premium. They're loaning you money now that you pay back in the future, and they know with inflation, those future dollars won't have the purchasing power of today's dollars. So to compensate themselves, they charge a little higher interest rate. In other words, the cost of debt includes an inflation premium. Or another way to say it, the cost of debt is expressed on a nominal basis, as is the stockholders' required return. They also include an inflation premium. Since the discount rate we're going to apply to our project cash flows is expressed on a nominal basis, we want our cash flows to also be expressed on a nominal basis to be consistent. Or I'll say it again slightly differently. If our cost of capital considers inflation, we want our cash flows to consider inflation. Any questions? Okay, I'm going to look at you one more time. Well, I'm looked your names. Oh. Wednesday, I don't have a script. We have finished chapter 12. Wednesday will be to answer your questions, or if there are any problems. We've worked the problems out of the slides. Well, we may not have worked them all, but if there are any problems out of the slides of the book you would like me to work, I can do that Wednesday. But I do not have a prepared review, so to speak. And also, once again, for your memory aid, which I sent you in typed form, you may handwrite all the notes on those sheets that you want and also use that. So in a sense, build your own memory aid onto the sheets I sent you. Any questions? Oh no, Dr. Good, I have one. Oh no, that's okay. All right. It's funny. Stop. All right, I'll stop. If you have no more questions, I'll adjourn the meeting. As always, it'll be posted to YouTube probably by tomorrow afternoon. We'll meet Wednesday, but I will not have a prepared script, an agenda. If we start the meeting Wednesday and nobody has questions or problems, it may be a very short meeting. You guys take care. I'll see you Wednesday.